Few companies capture investor imagination with a single question as sharply as DNL Industries did. When will the Batangas plant stop draining capital and start delivering returns? In early 2026, the answer finally emerged. After years of heavy investment and strained financial ratios, the plant has now logged its sixth consecutive profitable quarter. Capital spending, once the main concern on the balance sheet, has receded. The promise of expansion is beginning to pay off. But in business, construction is just the prologue. Now comes the harder problem. Can DNL grow revenues again? The first quarter results laid out a paradox. Net income climbed 5% year-on-year, 716.7 million pesos in a volatile economic landscape. Gross margin improved, free cash flow turned positive, and net gearing eased. These financials reassure. DNL is not simply promising payoff, it's starting to deliver. Yet the top line faltered. Revenues dropped 10%, with food ingredients, long a core growth engine, posting a sharp decline. Management attributes this to portfolio optimization, shifting away from low-margin commodities. That's a sound strategy, but investors know selling less of the wrong things is only half the battle. Selling more of the right ones is what drives growth. DNL's true strength lies in customization. Behind the scenes of food, oleochemicals, plastics, and consumer goods, it embeds technical expertise rather than just moving volume. This model shone through volatile times. Coconut oil price stabilization and resilient supplier relationships cushioned margins. Specialty segments like chemres and plastics powered profit growth, offsetting weaknesses elsewhere. Diversification proved its worth. Financial healing is underway. Cash balances are up, borrowings are down, and depreciation now outpaces fresh capital additions. Operating cash is shifting from plant spending to debt reduction and product development. DNL is transitioning from building to optimizing. But new pressures have emerged. Inventories have risen, payables nearly doubled, and the quarter's cash flow improvement relied partly on working capital timing. These are signs that the financial story is evolving. The investor checklist now pivots from Capex to working capital. The weakest link remains food ingredients. External headwinds and high input costs dragged profits down nearly 70%. Rationalizing the portfolio makes sense, but investors are watching for stabilization. If food ingredients remain soft, other segments must grow even faster to sustain earnings. Exports offer promise, but progress is gradual. While Chemres coconut-derived products led the way, exports still account for only 24% of sales, short of the 50% long-term target. Unlocking this growth will require patience and execution. In summary, DNL is a better company today, but not yet a faster one. The balance sheet is healing, margins are improving, and specialty segments are delivering. Yet revenue contraction and segment volatility signal an uneven recovery. The central question for investors is whether DNL is evolving into a leaner, higher-margin, export-driven business, or merely defending profits in a weak market. The Batangas project is beginning to work. But factories don't create value by existing. They must be filled with profitable orders. In 2026, DNL's story isn't about capacity. It's about selling into it. For investors, informed patience will be critical as the next chapter unfolds.